Welcome to the next episode of Up to 5 Minutes, where in less than 5 minutes you will learn the latest in all things real estate and mortgage lending, and hopefully sound a little smarter at your next cocktail party. So Alton, when people think about getting a mortgage, really they default to that 30-year fixed mortgage, but there are a lot more options out there that may be advantageous to buyers.
Absolutely. I think, again, like you said, most people think that's the only option available, and it's not true. We work with a lot of variety of different loan programs, and they each help certain buyers in a more advantageous way than that 30-year fix. It's all about your plan and your personal financial goals.
Okay. So what's the first option that you would recommend?
One option that's very popular is the 15-year. One of the great things about the 15-year is that you're going to have a lower interest rate right off the bat, but you're going to build equity faster because you're paying more to the principal at a quicker amount of time. So over the course of 30 years, if you look at the two, it often saves you $100,000, $200,000 in interest throughout the life of the loan. It can be a great way, especially if you're shopping under your budget.
There are other options just than a fixed rate mortgage. What are some adjustable rates and who would that be appropriate for?
Yeah, exactly. So you don't always have to have a fixed rate. There's the 5, 7, 10-year options for adjustable rates. What that means is that at that point in time, your rate will be set up with a certain index and it can go up or down at those particular years. Now there's limits onto it, but that's great for someone who was looking for a little bit shorter time in the home, or if rates are really high right now and you think you're gonna refinance, it might be a good option as well. I see it a lot with people who know they're only gonna be in a town or in that home for 2 years and know they're gonna get rid of that loan, because you do face the risk of it going up on you at the course of, or the end of the 5-year term.
And the way that the 5, 7, or 10 years works is the interest rate is fixed for those amount of years. Correct. And then it will fluctuate.
Correct. Yeah, that's a good indication. Make it set for those years, so you know it's not going to move for that 5, 7, 10, and then after that it usually changes every year or so.
And aside from interest rates and fixed versus adjustable, you don't need to do a conventional loan, because that's another term that gets thrown around a lot too.
Correct. There's a lot of options out there, from FHA, VA. There's what's called non-QM loans, like a DSCR, which is for investment properties. There are a lot of options available, and it's all going to depend on your financial situation. And that's why it's really important to have a consultation with someone who knows what they're doing, not just filling out an application online and getting sent a 30-year fixed rate, but making sure that they understand your goals, both financial and personal, short-term and long-term, and making sure they find the best program for you.
So I think the takeaway for everyone out there is that a mortgage should not be looked at as a one-size-fits-all.
No, it's quite the opposite. It's very personalized in every situation. Thank you for spending less than 5 minutes with us. Don't forget to like, share, and comment your questions down below, and make sure that you follow us on LinkedIn, YouTube, and Instagram as well.